Good day everyone, I'm Oliver Palma, your discussant for today. My topic is under Chapter 9, Introducing the Anglo-Saxon, European and Asian Models, as continuation to Mr. Opalek's report. So I'm going to discuss the remaining parts of this chapter. I am going to discuss the raising capital, the role of government, the economic freedom, and lastly, the legal system. And now let's move on to raising capital. Issue stock or borrow. Capitalist economic systems also differ in the way they raise capital. Small companies raise capital in the same way the world over. They save their own money to invest in their businesses. They borrow from relatives. After they establish, they borrow from banks. Different economic systems deal differently with the financing of new businesses that need more capital than the owners can raise themselves. Some economic systems have organized venture capital markets to supply such capital. Others are sorely lacking in markets for venture capital. When we say venture capital, it is capital invested in new businesses in which there is a considerable amount of risk. California's vaunted Silicon Valley is an example of a vibrant venture capital market, largely lacking in other countries. Corporations are distinguished from the legal forms of businesses by their ability to raise capital, often huge amounts in the billions of dollars. Corporations, unlike proprietorships and partnerships, raise capital by issuing stock and bonds in stock and bond market exchanges and by borrowing from lending institutions, most specifically from banks. As you can see, Figure 9.2 provides some insights into how the Anglo-Saxon, European, and Asian models use different approaches to raise capital. The best single indicator of the extent to which corporations raise capital by issuing new shares of stock is market capitalization. When we say market capitalization, it is the market value of outstanding shares. If XYZ company has 1 million shares outstanding trading at $10 per share, its market capitalization is $10 million. Economists with have higher market capitalizations as a percent of GDP tend to raise capital by selling new shares of stock. Those with low market capitalizations raise capital by other means. Figure 9.2 also shows that again with the exception of New Zealand, the Anglo-Saxon countries have market capitalizations in excess of GDP. Switzerland has the highest market capitalization because it is a small country with huge banks and pharmaceutical companies. European countries with the exception of Netherlands and its Royal Dutch Shell have market capitalizations well below their GDPs. Asian countries with the exception of the two city-states of Hong Kong and Singapore, which host giant multinational corporations and have huge market capitalizations, have capitalization rates even lower than Europe. Corporations can also raise money by issuing bonds. Corporate bonds require the corporation to pay interest over the life of the bond and then return the principal at maturity. The value of outstanding corporate bond debt is a measure of the reliance of corporations on raising capital by issuing debt. It should be noted that corporate bonds account for a relatively small share of a nation's bond debt. Other forms of bonds tend to dominate, such as mortgage debt or the debt of federal, state, and local governments, which for a number of countries is approaching or exceeding the value of GDP. As you can see in the figure 9.3, it does not reveal strong patterns among the three prototype economic systems, although the Asian countries, with the exception of Singapore, raise relatively small amounts of capital relative to GDP by issuing corporate debt. We will later explore why Asian countries, especially the poorer ones, do not raise much capital in stock and bond markets, despite the supposed lure of investing in emerging markets. For now, we can say that considerable trust in the corporate governance and management of a corporation is required to entice investors to buy stocks and bonds, especially in foreign countries whose business practices may be unknown and suspect. Companies that raise their capital through stock and bond exchanges must satisfy an impersonal capital market. When we say an impersonal capital market, it is one in which the capital is supplied by entities outside of and unrelated to the enterprise on the basis of economic criteria. In such a market, family or political relations count for little, if anything at all. If the deal is a bad one for the suppliers of capital, they will reject it. Banks, especially those that operate within the country and have local ties to management, should have a better sense of who is creditworthy and who is not. They may also make decisions based on personal or political relations or the intertwining of the bank with the borrower. Banks, as recipients of deposits, are positioned to channel these deposits for consumer loans, home mortgages, or business loans. US banks, for example, make the majority of their loans to consumers and home buyers. Their overlending was a prime factor in the credit crisis that began in late 2007. As of January 2011, of the $9.2 trillion in US commercial bank credits, only $1.2 trillion went for commercial and industrial loans. The largest Dutch bank or ABN AMRO on the other hand devoted some 40% of its loan portfolio to business lending. Unfortunately, an exhaustive study would be required to break down bank lending between business lending and other forms of lending, such as mortgages and consumer lending. As you can see on figure 9.4 shows that Asian economies are more dependent on bank credit than their European or Anglo-Saxon counterparts. The two exceptional bases of limited dependence on bank credit are the United States and Canada, both countries in which the banking sector focuses on real estate and consumer loans than on business lending. The role of government. The size and impact of government are key institutions that determine the workings and performance of economic systems. The size of government is measured by its spending and taxation. The impact of government can be distinct from its size. Through regulation of unfunded mandates, the state can impose costs on businesses that do not depend on its size. A government that spends little of society's resources or imposes smaller tax burdens could still impose a heavy regulatory burden. However, usually the size and impact of government are strongly correlated. As you can see in the figure 9.5 captures the size of government as the ratio of government spending to GDP. Government spending is the better measure of the role of the state as a user of resources that could have been used in private activities. With respect to the role of government, the countries divide rather neatly into the three groups. The Asian countries have relatively small shares of government with the exception of Japan. The European countries have uniformly high shares of the state in overall economic activity. The average European shares for the first decade of the 21st century are all between 40 and 50%. By the end of the decade, only three remain below 50%. The Anglo-Saxon state shares were between 30 and 40%, with only Canada and the United Kingdom reaching 50% or above in 2011. The Asian countries except Japan tell an entirely different story. They fall between 15 and 30% of GDP. In the Asian countries, the state takes a much more modest share of output than in Europe. The United States represents a bellwether for the rise in government. Currently, the share of government spending is in excess of 40%. The debate in the United States is about whether to move in European levels to fund a European-style welfare state or return to the lower rates of the past. Economic freedom. Economic freedom measures the degree to which participants in the economy are free to make economic decisions unconstrained by state intervention or corruption. Are businesses free to invest as they wish? Are they overburdened by taxes? Must they pay off corrupt officials? Are their property rights secure? Are they free to choose their jobs and are employers free to fire them? Some of these concepts can be measured, such as the fiscal burden or tariff rates. Others, such as corruption, must be gauged by the perception of those doing business in the country. The Heritage Foundation's Index of Economic Freedom measures the economic freedom of 183 countries of the world according to 14 indicators of economic freedom. At the top are the Hong Kong, Singapore, and New Zealand. At the bottom are Cuba, Zimbabwe, and North Korea. These and other measures of economic freedom are far from perfect, but we are expected to capture real differences among nations. Our question is whether they yield distinct differences among Anglo-Saxon, European, and Asian economies. As you can see, figure 9.6 reveals a striking pattern. The Anglo-Saxon countries tend to have stronger economic freedom scores than their European or Asian counterparts. There are exceptions. As already noted, the city-states of Hong Kong and Singapore are top-ranking in terms of economic freedom, but the other Asian nations rank below their Anglo-Saxon counterparts. The lower-income Asian countries have rankings that are quite low compared with either the Anglo-Saxon or European countries. Although Denmark and the Netherlands compete with the Anglo-Saxon rankings, the others, especially France and Italy, fall well behind. The three sub-indexes of economic freedom in figure 9.7 yield similar results for all the three models for trade freedom. It seems that all the countries in figure 9.7 have equal trade freedom, even the poorest country. The Anglo-Saxon, the European, except Spain and Italy, and the more affluent Asian nations have about the same levels of business freedom. The poorer Asian countries have much less. There are differences in freedom from corruption. There is more corruption among poorer Asian nations. Elsewhere, among the Anglo-Saxon and European countries, the levels of corruption are relatively uniform except for Italy, which has an Asian-style level of corruption. The legal system. In an earlier chapter, we said that the institutions that constitute the economic system determine the rules of the game by which the system operates. Societies that have no rules of the game operate on an ad hoc basis. Usually the strongest and the cruelest win with no rules. The legal system is in the institution that spells out the formal rules of the game. It is comprised not only of the laws themselves, but also the mechanisms by which they are enforced. Nations have a choice of legal systems. Usually the legal system was decided on in the distant past. English law began to form in the 15th century or even earlier. The legal systems that prevail in much of Europe draw from that of ancient Rome. Other countries were relative newcomers. The German and Japanese legal codes were adopted after World War II. The new Russian legal system was put in place in 1993 and Egypt will shortly begin considering a new legal system. There are three basic types of legal systems: common law, civil law, religious law, primarily Islamic Sharia law. When we say common law, it is a legal system based on custom and precedents rather than a written legal code. Common law originated in medieval England and spread into English offshoots in North America and then to English colonies, while civil law is a legal system in which laws are written and codified and are not determined by judges based on custom or precedent. Islamic or Sharia law is a religious law based directly on the teachings of the Quran as interpreted by the senior religious figures. Nations can have mixtures of two or three of the above pure forms of law. Table 9.3 lists the Anglo-Saxon, European, and Asian countries according to their legal systems. The implications of the choice of legal system will be explored in the later chapters. For now, we note that the Anglo-Saxon countries have common law legal systems, with the exception of Switzerland. The new European economies uniformly use civil law, and the Asian economies have all three types of legal systems, even mixing them together. We add in Table 9.3 a new category of countries that have adopted Islamic Sharia law either in its pure form or as a mixture with another legal system in cases where the population is of mixed religions. Islamic laws apply to the Muslim population and another legal system applies to the rest of the population. Origins of civil law. Civil law owes its origins to imperial conquest and to competition between the king and feudal lords. The two major historical exercises in written and codified law were motivated by imperial conquest. In Roman times, the emperor needed a uniform set of laws to govern his far-reaching empire, which extended from northern Africa to England and to Constantinople at its peak. His governors needed a written law that would bring some uniformity to the legal system throughout the empire. Emperor Justinian ordered that Roman laws be collected into a clear system of laws, and the Justinian Code was completed in 534 AD. The Napoleonic Code was drafted on the orders of Napoleon Bonaparte in 1804 to provide a uniform legal system for its territorial conquest that included much of Europe. The Napoleonic Code spread throughout this territory and supplanted the patchwork of feudal laws in effect throughout most of Europe. Civil law proved particularly suited to countries such as France and Germany, where feudal princedoms competed for power with the king. Each fiefdom or barony had its own rules, which meant that laws were unevenly applied across regions. The Napoleonic Code was intentionally written in clear and concise language so that it could be uniformly applied in each territory. Civil codes could not be enforced by local juries or judges, as was the case with common law. Rather, civil law was enforced by professional judges trained in central institutions and appointed by the central government. We shall show in later chapters that the legal system affects the choice of other institutions and also economic performance. The choice of legal system is also part and parcel of Huntington's Clash of Civilizations that see in Chapter 1. In geopolitical battles, such as in Iran or Afghanistan, wars have been fought and revolutions waged over the introduction of Islamic law. In many countries today that have substantial Muslim populations, there is political debate over whether Islamic law can be applied separately to the Muslim population. And that's the end of my presentation. Thank you for listening.